Good day to everybody. I am Nicolas, Bornozis, President of Capital Inc., and I would like to welcome you to our webinar today. It is our pleasure to welcome Mr. Hamish Norton, the President of Star Bulk Carriers. As you all know, Star Bulk is a global shipping company that provides transportation services of dry bulk cargoes around the world. On a fully delivered basis, the Star Bulk fleet includes 150 owned modern vessels with an average age of about 11.9 years, and the fleet composition is highly diversified across all major vessel classes in the dry bulk sector. And it has a total capacity of about 15 million deadweight tons. Now, Star Bulk's common stock trades on Nasdaq under the ticker symbol SBLK. And before we begin, allow me to mention the usual disclaimer that this discussion is for informational and educational purposes only. It should not be considered investment advice or an offer to buy or sell securities. And as an additional disclosure, Capital Inc. is very proud to serve as investor relations advisor to Star Bulk Carriers. And with this, I would like to thank Hamish again for joining us at our webinar today. We appreciate your taking the time to be with us following the company's first quarter 2025 earnings announcement that took place a few days ago. It is a great opportunity to follow up on key developments, get your insights into market trends, and hear more about Star Bulk's strategy moving forward. And let me start with the first question on the first quarter reflections. To begin with, is there anything you would like to highlight from your first quarter results that shareholders should take away, particularly in terms of how the company is positioned for the remainder of the year?
Sure. Well, I think first of all, I should point out that pretty unusually among dry bulk companies, we were able to report positive GAAP net income. And that's a result of some relatively good chartering performance, some very low operating costs, very low overhead costs. I think in a market like the market we had in the first quarter, it really shows the power of the Star Bulk platform. The other thing that I think is worth paying attention to is the synergies we were able to realize with the Eagle merger. When we closed the Eagle merger, we reported to investors that we expected to be able to reach 50 million run rate synergies by the end of 2025. And we reached over 50 million in the first quarter of 2025. So 18 million a quarter is it's a well over 50 million run rate. It's over 70 million run rate. And we have more synergies to go. So that's working out actually quite well. Otherwise, it was a relatively weak market. We think that the rest of the year may be better than the first quarter, but we're not expecting a miracle during 2025. I think the share is priced is not priced for perfection. Let's put it that way. I think there's a lot of room for investors to make a lot of money.
Well, Hamish, that brings me to the next question, actually. And this is a topic that we have discussed together at our last forum, the shareholder value and the discount to NAV. You're not the only one. Your shares, along with everybody else in shipping, continue to trade at discount to NAV, a topic, frankly, that it makes no sense, but regrettably, this is what's happening across the board. So how are you approaching this disconnect? And what actions, such as share buybacks or dividends, are you prioritizing to unlock shareholder value and close that gap?
Yeah. Well, first of all, I think there are a lot of shareholders who think that NAV may be sort of theoretical. And they may think that, right, I mean, this is an appraised value, but you can't actually sell the assets at this price. And what we're finding is that that's actually not true. We've been selling many of our older and less fuel efficient ships. And we continue to do that. And we're getting prices that are, plus or minus 5% around, the appraised value. So we're able to realize, NAV in actual ship sales in high volume. So it's not theoretical. It's a real value. And if we sell ships and we use the cash to repurchase shares, we are realizing very significant arbitrage profits. Um, and you saw us do that in the first quarter. I think we're probably going to be doing that in greater volume going forward. And I think we're going to create a lot of value for the shareholders who stick with us.
Well, clearly, selling assets at NAV and buying shares at below NAV is a great arbitrage and very good for investors. But I think the case here across the industry is that shipping shares should not trade at NAV because it disregards all the investment you have made in infrastructure, computers, people, chartering, and so on. But
Yeah, no, I mean it's not very complimentary to management to have the share trade below the net liquidation value of hard assets, especially when we're earning, on the order of $1,000 a day more than many of our peers, and in some cases $2,000 a day more than some of our peers. We think we create a lot more value with a ship than others would create. And so, frankly, we think that net liquidation value of hard assets is sort of where you would start, and then you would add value for the management. But frankly, if the market is prepared, if people are prepared to sell the shares for 40% below net liquidation value, I think we're prepared to buy them.
So let me now take you to the next topic of long-term capital allocation, which obviously includes all these capital returns. Now, you amended your dividend policy, stating that you will be paying going forward a minimum quarterly dividend of 5 cents per share. Now, looking beyond 2025, what is your overall capital allocation strategy? How are you weighing reinvestment, further deleveraging, and continued capital returns in this evolving market environment?
Okay, yeah. So first of all, we're deleveraging in some sense automatically because our bank debt is amortizing. And it's amortizing in the amount of roughly $250 million a year. And we're continuing to basically pay it down and not replace that debt. So at the moment, our leverage is below the scrap value of our fleet. We're very low financial leverage at this point, and it's just going to keep going down. And then with our cash flow after debt service, um, you know, our new dividend policy basically um, calls for a dividend that not less than 5 cents a share, um, but not more than 60% of our cash flow after debt service, and probably less than 60%. Because, with the share at its current valuation, it probably makes more sense to use, a substantial amount of that operating cash flow to repurchase shares, which we think is a better use than paying large dividends at this point. But there will be some dividends. And then we may retain some cash for possibly greater opportunities in the future. But we think we've got pretty good opportunities right now. Um, with the share.
So recapping on the dividend policy, as I understand it, as a shareholder, you can count on a minimum of 5 cents per share, and then depending on market conditions, you can also have on the upside based on your usual formula.
Yeah, yeah, and we've got over 400 million of cash, so we can pay that sort of 5 cents a quarter dividend in the case of, a quarter where our dividend policy would otherwise not call for a dividend. We can afford that for quite a while.
So since we're talking about the share and capital returns and capital allocation, let me briefly touch on the fact we have seen interest from a number of major parties, being major shareholders, Danaos, John Frederickson, and so on. Would you like to comment on that?
Sure. Danaos has been a shareholder since we closed the Eagle merger. John Frederickson has come in more recently. These are very knowledgeable shareholders, and they're staying with us, and I would expect they know what they're doing. And if it's good enough for them, I would have thought that it would be good enough for a number of other institutions. Let's see if those institutions figure that out.
And I think that now also increased their shareholding post the merger.
Somewhat,
Yes.
somewhat.
As it was
Yeah,
expected.
yeah.
Okay. So now let me go to market conditions and the impact of trade developments on fleet activity. Now, we have all these ongoing geopolitical tensions and the recent US-China trade developments. What impact have you seen or anticipate on trade routes? And how are you positioning your fleet deployment in light of these developments? Have you seen any difference or shifts in demand or chartering behavior from your counterparties?
Dry bulk has not been very affected by the trade wars. The container shipping business has been very significantly affected. I think the tanker business has not been affected as much as the container business, but more than the dry bulk business. We have not seen really much effect on the dry bulk business from the trade wars. What we've seen is that, what we're looking at is more potential changes than actual realized changes. If the Suez Canal opens up, that's going to have a negative effect on the dry bulk market. Not as big a negative effect as it would have on the container market, or the tanker market, but still definitely negative rather than positive. If the war in Ukraine is stopped, that's probably a positive. That should be able to lead to increased grain shipments, and possibly the reemergence of Black Sea port congestion. um, and possibly the resumption of legitimate trade activity with Russia. Um, you know, there has been some issues in Guinea with mining and well, I guess it's not mining licenses, but export licenses for bauxite, which the government of Guinea wants the local bauxite miners to refine into alumina inside Guinea. And that has been a negative impact on the Cape market. If that gets reversed, that could be very helpful for the Cape market. Um, you know, China has been making a lot. They haven't cut their steel production much at all. In fact, their steel production very recently went up significantly. So, that has not been affected by trade wars. You know, Basically, we're thinking that the market in 2025 is going to be sort of not great, but not terrible. We think the first quarter is going to be sort of about as bad as it gets, and it's not going to get a lot better in 2025. But the value of the share is giving people quite a bit of room, um, relative to that sort of market forecast. And you know, we think it's a very interesting opportunity.
Well, I had a question. I mean, you already answered about the dry bulk sector demand outlook. Anything you want to add here in terms of any particular trade routes or cargoes that might benefit this year or going to the next?
Sure, sure. Iron ore is probably going to get better in the fourth quarter, um, where we think the Simandou mine in Guinea is probably going to start shipping, and that's probably particularly good for the Cape market. Um, Clarkson's is thinking that grain trade is going to be down in 2025, but we're not so sure that that is actually going to happen. You know, we think there is a significant chance that Brazil and Argentina may increase their market share, and they are fairly far from their export markets. So that could lead to increased ton miles of grain. Not a big effect, but it could be a positive rather than a negative, which is what many people expect. So we think it could surprise on the upside. And then minor bulks look like they're going to do quite well. So the supers and ultras, which carry the minor bulks, we think may do well. And that will be helpful. Um, when we closed the Eagle transaction in April of 2024, that was just about when Capes started significantly outperforming Supras and Ultras. And while we think Capes will do well toward the end of 2025, the Supers and Ultras may benefit also from the increased ton miles in the minor bulks. Yeah, and for the benefit of people who are not familiar with the dry bulk shipping industry, the major bulks are iron ore, coal, and grain, and the so-called minor bulks are basically all the other cargoes that have a small market share, like copper concentrates, scrap steel, salt, um, you know, nickel ore, things that have a small market share and move in smaller lots.
Thank you, Hamish. So I think when whereas we're having all these question marks um, on the demand side, I think things seem to be a bit clearer on the supply side.
Yes,
So
yes.
the supply side has always been one of the favorable contributors to the sector outlook. So new vessel deliveries remain limited, demolition activity is low, but the aging of the fleet is progressing. So what is your current outlook on the overall fleet growth in the sector, and how do you expect this to shape rate dynamics going forward?
Yeah, so the order book, is a lot closer to its all-time low than it is to its all-time high. Order book is around 10% of the fleet. We're expecting about 3% of the fleet to get delivered as new buildings this year. Um, we're not expecting a lot of scrapping this year because basically, the fleet is profitable at least before debt service for most people. Um, you know, it's it's not the same delivery profile in each vessel class. Supras and Ultras have a larger order book relative to the fleet. Capes have a smaller order book relative to the fleet. So that will be helpful for Capes. Um, but there are some there are some good things happening. First of all, we've got ship owners concerned with their carbon emissions, about their carbon emissions. They have the carbon intensity indicator that they have to worry about for the IMO rules. They have the European Union, which is has brought the energy trading system to shipping, has got Fuel EU for shipping. So, if you're trading in the European Union, you have to worry about the European Union carbon rules. If you're trading elsewhere, you have to worry about the IMO carbon rules. What that's going to do is keep the fleet going slower than it otherwise would go. And, normally, if fuel prices dropped, which they have done, you would see the fleet speeding up, which increases the fleet's carrying capacity, which is bad for charter rates. We have not seen that happening to nearly the same extent that it would otherwise normally have happened. We think because of people being concerned with their CO2 emissions. And that should just get better. If for example, the IMO's carbon tax that was approved with the latest MEPC is implemented, and it seems like it will be because it got a majority vote. Um, it's going to be very unattractive to order a fuel oil only new building. Because that fuel oil only new building, no matter how efficient, unless it can burn biofuel, is going to start paying massive penalties under the IMO rules pretty soon. And there are differing opinions about the future availability of biofuels, but we are very skeptical that biofuels will be available in more than tiny amounts for shipping. Given that the aviation industry has a much stronger financial incentive to use biofuels. We suspect that the order book for fuel oil only dry bulk ships is going to shrink rather significantly. And people are going to wait and see what they need to order, and whether it's an ammonia fueled ship, a methanol fueled ship, we'll see. Or I suppose possibly biofuels will become available, but I think people are going to worry about that a lot more than they have been.
So, Hamish, if I understand correctly, a new build with fuel-only engine cannot burn biofuels?
It can burn biofuels. The question is, are biofuels going to be available?
Okay,
But biofuels are the only low carbon fuel that a fuel oil only engine can burn.
I see. So that limits exactly the scope of alternatives.
Right, right. And the aviation industry needs biofuels. And they don't have any other choice. Jet engines are not going to be able to burn ammonia, and probably not methanol.
But now you open the door, if you allow me, to the next question. Given all this, what is Starbucks? I mean, you have a very large fleet. What is your fleet renewal strategy? You have 5 new Kamsarmaxes being delivered in 2026, but how about the rest of the fleet? What's the overall
Well,
strategy?
as I mentioned earlier, we're selling our older and less fuel efficient ships. Um, we do not believe that now is the time to order new buildings. Um, you know, uh, Basically, if we have a dollar in the bank, um, using that dollar in the bank to buy a new building is a less attractive investment than using that dollar to buy a share of Starbulk that's trading at a massive discount to liquidation value. Um, and so, we believe that the shareholders are better served by either are retaining that cash for a future better opportunity, or using it to buy back a share.
Thank you. And I had a question on the IMO regulations. You answered it quite extensively. Is there anything you want to add there in terms of, we've seen a number of ship owners opposing the new IMO rules.
Well, look, we think that the IMO rules are fantastic, and we want the most stringent and complex regulation that the IMO can come up with, because it gives us a comparative advantage, relative to our peers. The more difficult compliance with the regulations becomes, the larger our advantage becomes. We are, among the largest dry bulk ship owners, and we can afford a very talented and thorough compliance department. That's not true of everybody in the industry. Frankly, we think that will help drive consolidation, which we think the industry needs to engage in.
Thank you. That's a very good statement. That's a very clear statement. So coming to the closing, if you would like to discuss a little bit about your strategic vision for the shareholders, what, if anything else, would you like to emphasize to shareholders about Starbucks' strategy and long-term vision? Are there any key messages you want to leave with? I mean, you already did so repeatedly regarding.
Yeah, well, look, I think what we want to leave people with is the understanding that we have basically the lowest operating expenses of any of our peers. We have just about the lowest overheads of any of our peers. We we employ directly the people who manage our ships. We are management is totally aligned with the shareholders, and we are not going to bloody-mindedly make new investments if our share is trading where it's trading now. So we're thinking about the best thing for the shareholders, and we are shareholders, and that's where our focus is.
Hamish, that brings us to the conclusion of our discussion. Thank you very much for joining us today, and thank you for sharing your insight. We appreciate your time and the valuable update on Star Bulk Carriers.
Thanks very much, Nicolas.
Of course, always a pleasure to have you with us. By the way, I'd like to mention that the full interview will be available at www.capitallinkwebinars.com. It will be on our YouTube channel, and it will be shared across our platforms and channels. So thank you again for being with us today.